So hello and welcome to the second season of the No Bullshit Property Podcast, brought to you by Cert Property.
I'm Howard.
And I'm Paul, and we'll be talking to Jack Poxon from Graphene Commercial Finance to discover the market outlook. And
Tom.
I
was wondering whether you were just going to acknowledge there was two people here or not.
Of course.
Also from Graphene Commercial Finance. I'll help you out there.
So before we get started with today's episode, just a quick reminder to check out our previous episodes, which give you an insight into our approach to transformative property management in the ever-growing build-to-rent sector and how we're building the sustainable communities of the future.
You've almost blown our one-take policy
I
already. Should we move on to market news?
Yes. So I think the biggest news of the month is the Renters' Rights Bill. It's the first reading's been in Parliament on the 11th of September. The second one is due on the 9th of October. So this we've talked about previously. It was a little bit stop-start under the last government, but the Labour government are committed to passing it through. With the Labour majority, we expect it will come into effect as soon as summer next year. So what does it mean? It aims to revolutionise the sector, but basically enhance tenant protection, repealing the Section 21, eliminating fixed terms, expanding rent repayment orders, and introducing a landlord's ombudsman. So what does it mean? Obviously, it gives tenants a lot more rights. It makes it quite difficult for landlords to unfairly evict tenants. It's possibly the biggest piece of the lettings legislation of recent times.
Thoughts?
Lots of differing thoughts. So some things are positive. Some things I think it will make it difficult for landlords, as I said, for no-fault evictions. Will it defer landlords from the market? Possibly. But on the other hand, I think it'll ensure there's a lot more cases going through the courts, which perhaps wouldn't have done before. It'll also make it easier without fixed terms for tenants to leave and not get into masses of arrears, which then leads to distressed landlords. So I think there's lots of different takes for it, lots of different viewpoints, some positive, some negative. It is needed, though. It is needed to revolutionise the sector.
Yeah. Okay, good stuff. Other bit of market news, obviously, Bank of England has maintained base rates at 5%, which leads nicely onto our topic today. I think everyone was hopeful of a rate cut, but probably suspected it wasn't going to. What did you guys expect, or what were you thinking ahead of it?
It's the hope that kills you, say, isn't it? I wasn't surprised today. You know, if you look at the voting of the committee members, it was 8 to hold, 1 to reduce, and really there's been an adjustment of expectation over the last few months that rates went up very quickly, but they're unlikely to fall in a similar fashion. So it's probably likely now that we'll get one more rate reduction before Christmas, and then I think whoever puts their money on more than a 1% rate reduction next year might be doing quite well. So yeah, it wasn't a surprise today, and it's not going to fundamentally change the current interest rate environment.
Mm-hmm.
Yeah.
Consecutive rate cuts was always going to be difficult, and hindsight's a wonderful thing. Tom and I could sit here today and say we knew this was going to happen. We didn't. But as Tom alludes to, one more rate cut this year, likely. Where do we end up next year? In and around 4s is the news that I read, and we all read the same news. So, yeah, not unexpected.
Yeah, indeed. So, segueing nicely into today's episode. So, obviously, we've just introduced you guys as being from Graphene Commercial Finance. Do you want to tell us a bit about Graphene, your backgrounds, and then, we can talk a bit about the financing market for the property development and investment sector?
Should we start by backgrounds?
Yeah.
So I'm Jack Poxon, come here today. Thank you very much for the invite. My career has been in banking and finance ever since I got going out of university. I used to work for one of the UK's largest high street banks, and in there I did front office roles, middle office roles, back office roles, a real good breadth of experience. The clients that I worked with were massive national global corporates all the way to one-man bands, MOT garages. So I got a real good grounding in what the UK business landscape is like and also how a bank works. I loved it. I took a natural interest to property finance, and what I saw or felt like I saw at the time was that high street banks are losing market share in the part of the market I want to work at, and challenger banks, or what is known as challenger banks, are gaining market share. So I pivoted my career, joined the challenger bank. I've spent the last 4.5 years up until the start of this year doing property finance deals in the north of England. Fantastic experience again. We would look at, hundreds of £1 million worth of opportunities a year, but we'd actually only write, say, 3-4% of that. My curiosity led me to where does the other 94-95% go? And where it went is through the advice of brokers is to other banks. And the reason for that is over the last, say, 10 years, it's become an extremely fragmented market. There is stacks of specialist lenders doing their own specialist types of finance. So curiosity led me down the broker path. I thought that's my next career move. I worked with Tom as part of my journey along that, and the timing was as good as ever going to be for us to come together and form Graphene. So before we tell you a bit about Graphene, I guess some of your background, Tom?
Yeah, so Tom Bamber, fellow co-founder of Graphene with Jack. I've worked in the banking and finance market for about 15 years now. So the last 5 years I've been operating as a broker, and prior to that I started my career with Barclays in their corporate team, working with a range of SMEs and larger corporate clients, and then moved across to Santander in their corporate team and was originating a range of cash flow and property finance deals on behalf of the bank. And that could have been everything from an industrial unit that needed refinancing for a family-owned business, through to 1 million square foot of industrial and logistics space for one of the best-known retail and tech businesses in the Northwest, and everything in between. It probably makes sense to explain that in parallel with that, my dad worked in commercial banking. He went into the broker market in 2008 and established his own business, and we had conversations at several points about whether I would help with his succession planning, and we agreed in 2019 that I would join his business and do a phased handover of his clients, which has led me to where I am today. So for the last 5 years I've been working with those property clients on a range of development funding, investment funding, bits and pieces of cash flow funding to complement those businesses. And me and Jack have got to know each other over the last 2 or 3 years. We did a deal together, went at his former employer last year, so I got to see him at close quarters, and we decided to join forces, and that's where Graphene has come from.
Why is it called Graphene?
Why is it called graphene? So graphene is a material that was invented at Manchester University. If you Google its properties, it's strong yet flexible, which we would like to think maybe mirror our approach to working with clients and lenders. We wanted something that had some affinity to the local area, and some of our other ideas like hacienda probably weren't appropriate. So we landed on graphene. It's also a very fragmented market from a broker perspective as well. There's over 1,000 commercial finance brokers in the UK, so you need to find something that makes you distinctive and hasn't already been taken. So that's where the name Graphene came from.
And whether you like it or not, Paul, it was the best of a bad bunch, let's say.
No, I do like it. I like the story.
No, it's good. Yeah. So we've had a consistent theme over the last few months on the podcast, talking to people about property development and challenges in terms of viability. And it was interesting for me earlier this week to go to a talk hosted by Greater Manchester Pension Fund, and the Deputy Prime Minister also spoke there, and it's on everyone's lips in terms of viability being a challenge. And as we were just talking about there, interest rates remaining at 5%, part of that challenge is development finance and the costs of it. Overview of state of play of the development finance market. We're in a high interest rate environment. How does that translate into appetite? What's out there? And compared to how it's been in the past, since we've entered this high interest rate environment.
Prior to this, Howard, we actually had a bit of a discussion. We talk about development finance day in, day out, so we think it's the centre of our world, which in reality, most people, when we look at the residential apartment blocks around us, are not too bothered about development finance, but we all know these buildings were built with some consideration of funding provided by usually a lender. So it's a very important cornerstone, or should you say pillar, of the UK market, from residential sectors through to business sectors. It's involved in pretty much everything, so it's really, really important. So when we hear the government very keen to really push on with house building and improving kind of quality of housing, funding and development finance has to come into that. So development finance, it's important. It's very cyclical. It follows the tune of the economy. In good times, it's good or easier. In bad times, it's harder. But it's a market that's evolving and continuing to evolve. I've alluded to it, that banking is quite a fragmented market. 10 years or so ago, there would have been a handful of high street banks and institutional funders able to provide development finance. Now, it's a list as long as my leg as who can provide development finance, and it's important to understand the costs and benefits of all those different operators and offers. So it's important. It's changing, but it's key to call it UK PLC, I would say, in my opinion.
Yeah, of course. Like I say, definitely viability, something that was talked about in the presentation I went to. Obviously, Labour set these targets of housing delivery, but if it's expensive to build and it's expensive to borrow, it's difficult to hit those. So I guess you talked there about the fragmentation of the market. Has that been a positive thing as far as the market's concerned? Because you're right, when I first came into the industry, there was a handful of the big national banks, Irish banks, a few other like Danish, Icelandic banks that, we all know what happened with a lot of those. But as you say now, that marketplace is debt funds, it's the high streets, it's the challenger banks, it's specialist development finance providers. So has that been beneficial to the market and where we're at today, do you think?
It's beneficial in that it gives borrowers more options, and fundamentally that's what they've needed. If you look at the cohort of lenders, the main clearers, as I would call them, the big four, so HSBC, RBS Group, or NatWest Group now, Lloyds, and I'm in a brain fart there, and the fourth one. If you look at that cohort of lenders, they, as a result of the GFC in 2008-2009, have had more conservative credit appetite, and that tranche of funding in the market has needed to be replaced. So that has been replaced by challenger banks, debt funds, family office money, lots of different liquidity sources. So it's needed to play its part, and that's been helpful to borrowers. The challenge is that it makes the market more difficult to navigate. I'm sure 15 years ago, you probably had quite a short list of telephone numbers of people that you could talk to on a particular transaction. It would be easy to put together a list now of 50 lenders to talk to on a transaction. So the benefit is it's replaced a gap in the market. The thing that's tricky is that it makes it more difficult to navigate.
Yeah, I mean, something that we've talked about offline separately, almost feel like as a borrower, you've actually got to be aware of your counterparty risk in terms of who the lender is, because there's so many names out there that you might be encountering for the first time, and actually you've got a risk of, well, have they got the ability to follow through, and actually will they support me through this, depending on what happens. And always in development, things don't go to plan and something happens. So it feels like, with that bigger pool, there's some benefits in a wider market, but there's also some risks as well. from my perspective.
One thing I'm no doubts we'll touch on is the level of scrutiny that lenders require from borrowers. But you're right, borrowers have a similar enhanced level of scrutiny back on who is their funding partner, what experience do they have, are they local, do they understand local market nuances? We all know that one street corner can be different for the next on the ground here in Manchester. So those are very important, and I guess not selling our services here, the role of a broker is to ease that and provide some kind of anecdotal as well as real life experience of who you're working with.
I think that's where the role of either the responsibility of a borrower to ask the questions themselves or a debt advisor or broker has evolved. 20 years ago, it would be quite unusual to ask a funder how they were funded, because the answer would normally be customer deposits and they were a traditional bank. I will regularly ask funders that I'm working with, just talk me through your capital base. How are you funded? It's not that unusual that some of the funders we work with will be reliant on a sole funding line, and that can make delivery a little bit more uncertain depending on where that funding line comes from. I think that particularly for peer-to-peer, if we look at that as a subsector, that was extremely active pre-COVID and pre-interest rate increases. The peer-to-peer market is now a much more difficult sell to people like you or I that would maybe want to put £10,000 in a savings account with a peer-to-peer lender, because you can get that return of 4 or 5%. With Santander, you don't need to put it with a peer-to-peer. And clients need to be mindful of how the organisation that they're borrowing money from is funded.
Yeah, absolutely. So this proliferation of funding sources and new funders entering the market, on balance, you seeing this as a positive in terms of what's happened over the last 10 years, whatever it may be, that this has kind of transformed?
You've teed me up there because I am a commercial finance broker.
Of course I'm teeing you up. You've got to talk about yourself a bit.
and we're here today telling you how difficult it is to have a fully gripped understanding of who these lenders are and who's available and what's not. So it's great for brokers, and it has genuinely opened up the role for brokers. When I first got into banking, I would be originating real estate finance loans. I never worked with a broker. It would be all direct, and I would be sitting in the local business branch. My phone would ring, the door would knock, and people would be here saying, can I borrow some money for X, Y, and Z? As my career moved on, the role of the broker became even more prevalent, and to be fully transparent, you would almost not go direct to clients anymore, because a broker you knew had full market access, a good broker would do a full kind of appraisal on behalf of their clients and present that to lenders, shortcutting a lot of the work that a lender would have to do themselves. It's also in parallel fair to say that lenders have acknowledged this, and they've probably, amongst other things, down-resourced and cut resource and gone on their own cost-cutting exercises, making it more and more difficult for them to have tons and tons of boots on the ground, building their brand and originating new loans. So overall, it's been great for brokers, but genuinely speaking more openly on behalf of the market, it has increased competition, and it has perhaps provided capital where it wasn't previously available.
You can probably bring that back into the discussion. Your original question was around viability, and the talk that you attended earlier this week.
Yeah.
The new entrants to the funding market over the last 10 or 15 years have meant that where we now have a range of viability issues, some are prepared to take more of a view and put more supportive structures in place than a Lloyds or a other high street lender might be prepared to do. And that's fine, because the high street banks are responsible to their shareholders. Some of the other institutions and smaller private lenders can take a more appropriate view on a particular scheme.
Yeah, and I guess that's the positive, as long as the market works as it should, in there being such a range of potential funding sources, is that you've got competitive tension, but you've also got a range of viewpoints as well. So does that actually translate through that you've got the ability to get a better deal because there's a wide range of market participants, or is everyone kind of offering the same thing?
It probably depends on what your definition of a better deal is. I always try to ensure that clients are not driven primarily by price. Clearly, the competition has stimulated price competition, if you like, between the funders, because they're always I talk to funders every day, and they will ask me every day what other funders are up to and what terms I've seen from other funders, because they want to make sure that their pencil is sharp. But I think more importantly than that, the range and the breadth of lenders at the moment has meant that better deals in terms of leverage, gearing, things like security obligations, term of facility. There's lots of other reasons why you might work with a funder, local market knowledge, so that it does make it easier to find a better fit. Because I view my job as trying to, it's almost like matchmaking, trying to find a good match between a lender and the borrower. And having as many options at your disposal as possible makes that job easier.
Perhaps a little bit harder in terms of having to knock on a few more doors and understand, because obviously people's policies change and appetite changes, so I guess there's a bit more legwork in that, but that's where the broker comes in again, isn't it?
It is genuinely plenty of legwork, but we enjoy doing it. It's what our careers have been for the last 10 or 15 or so years, has been talking the lingo as such. So we enjoy it, and we put in those hard yards, and lenders are very forthcoming with what they can and can't do, and all credit to them. They're when they can't do something, they're willing to say that's not our bag. So credit to them on that front.
Problem solving is satisfying, isn't it? And that our job at times is to solve a problem that a client presents to us, and that can be very rewarding when you find a solution. In the same way that I'm sure on some of your schemes, if you've looked at recently and you've got particular issues that you're trying to backfill, or viability issues, when you eventually find a way to solve that problem, it's very rewarding.
Another one comes up.
And another one, whack-a-mole.
So, going back to the viability, what do you think can be done to challenge that? Not challenge it, to solve it. Solve the challenge. God, what's wrong with me?
Too many challenges.
Last episode I was in a cast, this one I can't speak. Yes, I'll rephrase that again. How can we solve the challenges of viability?
That's a broad question, and I think
from a funding point of view, whilst we're in a high interest rate environment.
So whilst we're in a high interest environment, and I think it's accepted that we're going to continue in a high interest environment, just because Bank of England base rate may start to track downwards, swap rates are still quite stubborn, and a lot of development finance facilities are a fixed rate funding option tracked against the swap. So we're going to continue in a high interest rate environment for the foreseeable future. The way you can improve viability would be making sure that any grants borrowers have at their disposal they can apply for. I have relationships with Homes England and with some of the local authorities, so I try to keep my ear on the ground for any particular tranches of money that might be available. Fundamentally, if you start off with more capital on day one through the injection of a grant, it makes the scheme more viable. Looking at different debt structures, so that might be the insertion of some mezz funding at the top of the structure to help, or looking at a funder that's able to provide higher gearing on day one. There isn't a magic wand. I can't sit here now and say development finance can back solve all of the viability issues within the development market, but what they can do is try and have a really close understanding of the problems, and understand how some of those risks can be mitigated.
I think a big one for me that I've seen recently is some lenders taking a view on construction procurement. So 3, 4, 5 years ago, every lender out there wanted a fixed price design and build contract with a contractor. and if it wasn't that, then they weren't going to give you development finance.
Yeah.
I think over the last few years, sadly, we've seen quite a lot of administrations of contractors, and I think the whole premise of the fixed price D&B, a lot of banks have actually realised, or a lot of lenders have realised that, well, actually, it isn't quite as secure as we thought, having this fixed price. It depends on the quality and financial strength of the contractor. So it's actually just not the sort of safety blanket we thought it was. And it's taken a bit of time and probably some scars from some to realise that. But now, we've got a scheme currently that's funded as a construction management procurement, which I wouldn't have thought the lender or many lenders would have lent on that sort of procurement. So it's trying to, like you say, see what those challenges are in terms of viability, and introducing a bit of flexibility in terms of deal parameters to try and enable things to happen.
That's probably in part, though, a lender understanding where a developer's at in their journey. If it was a developer's first, a maiden scheme, and they had, I guess, fairly thin CVs, and they couldn't demonstrate that they could procure themselves, then a bank's unlikely to support them in that way. If you can demonstrate that you've got sufficient internal resource to manage some of those risks, if a bank can build a relationship, or any other lender, they're more likely to be willing to consider those types of agreements.
Yeah.
It's an overall more pragmatic approach, isn't it? And that's probably one example where the level of scrutiny a lender does require actually pays favour, because you can demonstrate and clearly articulate that we might not tick the box, but look what we are doing, and look how it works, and look how it makes the scheme viable. So it's a good example of that.
So, question for two sides of the coin here. Sure. What do you think lenders could be doing better at the moment? Name some names if you like as well.
You're not going to draw.
I'm ready to bleep here.
Yeah, I'm not going to get drawn into that trap. In general, what I think lenders could do better would be understanding the local markets in which they operate. I've had a number of frustrating conversations with credit teams or underwriting teams that are based in one part of the country, and at times they are disagreeing with or suggesting that comp analysis or valuation analysis for a particular geography somewhere else in the country is not right. And I will always try and work with a funder that does have some local market knowledge. I know it sounds quite an obvious thing to say, but lenders will often want to expand. Lenders, like any other business, want to make money and increase their market share without necessarily understanding the markets that they're going into. So I think they could be better at that. I'm not going to name any names. So I'm not going to fall into that
in fairness, that's probably quite difficult to achieve. If you're a lender who is lending nationwide, you've got a lot of micro locations to try and understand. So it's probably
But I think you then need to hire resource locally.
Yeah.
If you want to go into that market and you're serious about it, hire someone locally that understands that area.
You were saying before that's a challenge where they've cut a lot of the staff. So does that kind of form part of your role, in that you have to bring that information to them on behalf of your client, or do you have a say in that, or is it just point blank no if they've got that information?
I sometimes think of our role almost like a barrister rehearsing our courtroom arguments, and invariably now I will go and speak to valuers myself. Even if I'm working with an experienced developer that might have gone and done their own due diligence, I will pick up the phone to people that I know in the local market and ask for a second opinion. It's often referred to as desktop opinion, but I will quite frequently do that because I understand that, particularly, like you say, when some of the banks we deal with now have limited resource, they may not be in the part of the country where we're trying to agree a facility. In fact, with some of the funders that we work with, we go straight into their credit teams now. We don't go through a relationship manager. So you want to rehearse those arguments and put us forward as a compelling a case as possible.
Yeah.
So I've asked that in terms of what lenders could be doing better. Obviously, you're working with a lot of developers, and again, name names if you like. Hopefully not ours. What do you think developers could be doing better in terms of how they're approaching going out for funding?
Again, taking the question diplomatically and on a general basis, it's quite basic. Some obvious basics really. Being honest and transparent with what your business plans are and what you're looking to achieve and why sounds very basic, but is often skipped over. And then feeding into that is demonstrating what is your background, what is your track record, do you have the necessary skills and expertise to deliver this, what risks have you identified and how are you going to mitigate those. All of that rounded off is a very credible proposal that can be shaped and put forward to a lender and say, this is what we're looking for, make a decision, and we've done a lot of the legwork for you. And we help do that. We help scrutinise, as Tom alludes to. If we didn't scrutinise and didn't cast our own second opinions, we'd be leaving ourselves a bit exposed because we know lenders are going to do that. I guess from a client point of view, again, they can also probably refine their expectations as to what's achievable. We don't have magic wands and crystal balls and, terms are asked for and we go away and find them, because not everything is actually possible and feasible. So having realistic expectations of what can be delivered, and then coupled with that, what that costs. Maximum leverage often costs maximum pricing, and there's often a trade-off for that. So having an understanding of what's possible out there. And I guess the third thing is appointing the use of professionals. Many developers, bring expertise in-house, and that's fantastic and that's great. It's also beneficial to use external opinion and really, that external level of scrutiny, be that a valuer, be that something legal, or be that something finance related. So those broadly are the things that clients could do on that side of the coin.
I think something I have observed in the past, Jack's heard me reference this before, I call it summit fever, and it's where a client becomes that fixated on achieving something and wanting to get to the top of that mountain that they might not realise it maybe isn't the best project. And the reason it's called summit fever is because people often get to the top of Everest and then die on the way back down. And it's knowing when and being, Jack's point around being realistic. It's knowing when to maybe look at something else and not chase that deal that you've maybe looked at several times before and decided it wasn't appropriate at the time.
Have you ever had to tell anybody that?
Yes, I think it's part of. It should be a good relationship between a debt advisor or a broker and a client. It should be collaborative, and I've looked at schemes where I've felt that maybe they're not quite as appealing as the client may initially think, and that might be my own opinion, or I may go and speak to valuers in the sector, and also they may come to the same opinion. And there's, there is always the realism point. I know we keep coming back to this. There is a classic question that we get asked by funders on a regular basis: where are those valuation or capital value figures from? Because ordinarily, there will be a variance between the client's view and what an appointed surveyor who's going to assess that scheme for a lender is prepared to say it's worth. And what a good advisor should do is try and ensure that gap is as small as possible.
I like that, summit fever.
Taking this matchmaking analogy and analogy to new heights, isn't it? It's not going to happen for you.
Yeah.
Out of your league.
Well, you could say it's not you, it's me, couldn't you?
It's not you, it's the lender.
Yeah. But no, I think the short answer is yes, we should challenge and critique, and if we don't, the lender certainly will.
Yeah.
And we're just creating problems down the line. You know, we could overcommit and oversell our services and just completely fail to deliver, despite having winning a mandate for someone who needs X amount of funding. So it's important that we're clear and honest at the outset of, you know, what expectations need to be set and what's realistic.
So, something fever, I like that. I will remember that. I'm a big proponent of making property development more accessible and, I'm not going to say easier, but certainly removing hurdles for SME developers, which we are one. You know, we're not a big national, we're not a PLC. And if the UK is going to hit its housing targets, SME developers need to have support. You both mentioned separately about track record there and how that's important. Is that a almost insurmountable hurdle? Is that setting a very high barrier to entry that development funders kind of, that's almost like a computer says no point for them to say, you've not got any track record, so you can't develop, and we won't lend you any money on this. Is there a way around that? How can we support more SME developers?
So one of the most rewarding schemes I've been involved in was a development project up in Clitheroe, and that developer was upscaling. He'd previously done sort of 2, 3, 4, 5 unit barn conversions, that type of thing, and this was a 25 unit scheme of 18 apartments and 7 houses. Initially, the feedback from banks was that unless he entered into a D&B JCT type arrangement, he would not be supportable for that funding application. Instead, what we did is we went and found a project manager in the market that he could employ on a contract basis for 24 months, and he entered into a binding agreement with the lender that he wouldn't walk away mid-build. So there are solutions that mean if you don't have the in-house resource, but you've got the passion and I guess to an extent the resources, because it cost him to bring that person in, but it was a profitable scheme where he had the margin to be able to bring someone in to help him, that scheme then became viable. So there are ways around to help, I guess, soften that picture.
Yeah, no, I remember all too well when we were looking at doing our first scheme of scale, and the number of doors that we knocked on at the time, and it was just I know you haven't got the track record. No one actually offered up a creative solution like that, but we found it really challenging at that time. Ultimately, we found a lender that was willing to support us and take a view, in inverted commas, but found it really challenging. But yeah, I mean, great to hear creative solutions like that. But is that a barrier for a big chunk of the market? Even with solutions like that, is there just a cohort of lenders who are just, you need to have a track record and that's it?
It's a risk reward payoff from the lender's perspective here. Call it the most competitive pricing in the market usually comes when it's assessed as the least amount of risk. And that's not only on a leverage basis, it's also on a counterparty basis and who you're dealing with. So not to close the door on the most competitive pricing to the everyday SME developer, but you may have to bide your time a little bit, take on some more expensive funding in order to get Scheme 1, Scheme 2 under the belt before the doors start to open to perhaps more favourable pricing. Going back to Tom's point, the use of professionals, and not just a broker, other professionals, should overall enhance your credibility when it comes to turning up at the lender's door asking for terms. So it's having the right professionals on your side to perhaps cover some gaps that are in your track record. Not to say that you can't do them yourself, but it does enhance credibility 100%.
Yeah, good. So talked a bit about the market, where it's been, where it's at. Foresight now, crystal ball gazing. Where do you see
Here
things
we go.
going over the next 12, 18 months?
Should we fire off a prediction each?
Go on,
Yeah.
yes.
It's, I guess, what I don't see happening is there being another huge influx of lenders. There have been some fairly high-profile failures in the lending sector in the last couple of years. Banks seeking licenses that didn't quite work out for one reason or another. So the sources of liquidity are probably unlikely to change volume-wise. I think we probably are where we are with that. The market share of the high street banks has dwindled massively. That's, as we've already spoken about, has been replaced by a range of alternate lenders. That base is volume-wise is fairly stable. There'll be people coming in and out of that market. Where I think it would be quite interesting to see more of is green lending initiatives. It feels like there is a lag between what government wants at the moment and being frank, what probably most people want, which is really clean new green homes being built. They are more expensive to build, and at the moment there are quite a small number of initiatives in the development finance sector. So I'm not talking about grants, I'm talking about funding initiatives to help stimulate activity in that side of the market. There is a high street bank that we work with that if you build over a certain SAP score, they will provide the debt facility without an arrangement fee. And interestingly, because they're so committed to those green credentials, they will still pay us for our involvement in the deal. So it is a loss leader for them. But that's quite rare at the moment. And if we look at the investment funding side of the market, because me and Jack work with a lot of developers that are building to retain, they might be doing PBSA, co-working space, normal residential accommodation, supported living, lots of different subsectors, but building to retain. And there aren't any significant margin discounts for green schemes at the moment either. So whether something's an EPC C or D, you will pay the same price for your debt irrelevant of whether you've developed something to an A standard.
Yeah.
And going forward, that probably feels a little unfair.
Yeah. It feels like an area where there could do with being some government intervention and support. If government turns around to lenders and says, we will help you by providing X, and maybe it's a rebate on funding costs for providing a reduced rate for hitting an EPC target or a SAP target, that's going to certainly make that market a bit more compelling for lenders, isn't it?
Well, the government through the British Business Bank's been able to help in other ways in the past. Enterprise Finance Guarantee, commonly known as EFG, which then morphed during COVID into CBILS. That was to help stimulate SME lending. I've not seen anything similar at the moment to try and help with those green initiatives by way of either guarantee or funding lines.
Yeah, that's a great one. Difficult act to follow there. What's
No, he's ready. I could see he's ready.
Yeah, I don't know if I can top that, but just to add on to it, to make it my own, if we were to put a genuine prediction out there, it's coming. Only as of late, I was employed by a decent sized organisation, decent sized bank. They have exco level responsibilities on what are our green initiatives in-house, but also externally, and how are we going to support our clients and future clients with various different green initiatives. So you asked us for our predictions. That one's coming.
There we go.
What's not coming, or not coming at the same speed in other industries, is technology. If we were talking about any other business or marketplace here, technology, AI, that would be almost paramount in the forefront of our discussion. For some reason, in real estate finance, development finance, technology has definitely helped and become a feature, and it's helped procure databases and crunch databases and provide various different insights, but it's not helped the end-to-end journey either speed up or take out cost or, you know, take out hassle. So what's not coming is, what it'd be difficult to see coming, is a massive technology shift improving the overall end-to-end journey of procuring and delivering a development finance facility, for example.
I always think it's mad, even like buying and selling a property is just so archaic, and you know, we're going through that process with a few properties now, and it's just absolutely crazy that you're still like doing these manual surveys and answering these manual questions and things, and you think, it's just crazy.
Yeah, I was you know, I was going to put it back to you guys that you probably see nowhere more is it more prevalent than the legal part of a transaction. It is still to all intents and purposes manual and archaic. I think what I would say is technology can be utilised, and believe it or not, I still work with some lenders that won't accept things like DocuSign, you know, wet signatures only, which feels a little strange in you know, today's era. But technology can be utilised, I think, better. But we do work in quite a complex environment. Buy-to-let funders, for instance, can do what they call an AVM now, which is an automated valuation model. You certainly couldn't run any kind of automated valuation model for a complex new build scheme. You've probably got a better data pool of technology that you can pull at for comps, but it still requires someone thinking deeply about the numbers and whether they make sense, and you can't replace a person in some of those instances.
I'm just longing for the day that Revolut or Monzo do a development finance offering, and you can just go in the app, press the address, there you go, upload documents, and there's your money ready to go.
Well, then we'd be out of a job.
These guys,
You don't want that one, actually. Hold on.
Joking aside, you know, that scenario would put us out of a job as such, and we'd have to do some, you know, our role would evolve, but our you know, our brokers or a professional debt advisory's importance in the future is becoming more and more prevalent, because lenders are, as we've talked about, cutting down resource, less local market knowledge. They are heavily or becoming more heavily reliant on the professionals that they use, and a debt advisory brokerage role is becoming seemingly more and more important. Now, obviously, I would say that, but I think that is genuinely fair comment.
That's a nice plug to end it on.
Well,
guys, it's been fantastic. Thank you for your time. Very illuminating. Let's see what happens with those green loans and the Revolut development finance facilities.
Keep posted on the first one. No, thank you.
Thank you very much.
Guys.
Just a quick reminder to check out our previous episodes, which give you an insight into our approach to transformative property management in the ever-growing build-to-rent sector, and how we're building the sustainable communities of the future.